financial strategy for scalable business growth. When it comes to expanding a business, one of the biggest challenges entrepreneurs face is ensuring that growth is scalable and sustainable. This means that as the company grows, costs should not increase disproportionately, and finances should continue to be controlled efficiently. Creating a robust financial strategy is key to achieving this. Growth in a controlled manner, without compromising the financial health of the business. This video will guide you through the essential steps to building an effective financial plan, focusing on cost control, long-term planning, and raising investment, allowing your company to grow in a scalable and sustainable way. 1. Cost control, the starting point for sustainable growth. The first step to creating a solid financial strategy is to understand and control your business's costs. Expansion without proper cost control can lead to an uncontrolled increase in expenses, compromising profit margins and damaging the company's financial health. The key is to conduct a thorough analysis of operating expenses, such as salaries, fixed costs, raw materials, and other recurring expenses. By mapping these costs, you will be able to identify areas where you can optimize or reduce expenses without affecting the quality of the product or service. In addition, you will be able to create more realistic projections of how costs should behave as the business grows. Practical tip. One of the best ways to control costs is to implement a detailed budget and constantly monitor the results. This will help you identify variations, budget deviations, and areas of opportunity to reduce expenses without compromising operations. High cash flow projection. Planning is essential for scaling. One of the biggest difficulties for those who want to scale a business is the lack of sufficient cash flow to cover expansion needs. A well-planned cash flow is essential to ensure that your company has enough money to operate, invest in new projects, and continue to grow without facing liquidity problems. When building your financial strategy, it is important to project cash flow not only for the present, but also for the future. Make a forecast of income and expenses for the coming months or even years. Include different growth scenarios, such as increased sales, market expansion, or new products. This will help you identify the amount needed to finance growth in a sustainable way and avoid financial surprises. Practical tip: use financial management tools that allow you to monitor cash flow in real time. Having a clear and detailed view of how money comes in and out of the company will give you more control and predictability over your finances. Capital structure: how to finance growth without compromising financial health. As your business grows, you will likely need additional capital to finance expansion. This can be done through loans, investors, or even by reinvesting your own profits. The key here is to build a balanced capital structure that allows your business to grow without compromising its financial health. In a robust financial strategy, raising capital is a crucial step. If you choose to seek external investors, whether venture capitalists or angel investors, it is important to have a clear and detailed financial plan to present, showing how the money will be used and what the expected return is. In addition, consider the risks associated with external financing and be prepared to pay off these debts as the business grows. Practical tip: before seeking external financing, have a detailed analysis of how the capital will be used and what impact it will have on the company's finances. This not only helps you make more informed decisions, but also gives investors confidence. Start your profit margin and pricing strategies to maximize profitability. When it comes to scalable growth, it is essential that the business is able to increase its profitability as it grows. To achieve this, the pricing strategy plays a vital role. Pricing should be based on the value delivered to the customer, the company's fixed and variable costs, and market conditions. One of the most effective strategies to ensure that growth is sustainable is to work to increase the profit margin. This can be done through improvements in operational efficiency, negotiations with suppliers, increased productivity, or even by gradually increasing prices without losing competitiveness. Practical tip: whenever possible, review your pricing strategy and seek to increase the added value of products or services, whether through quality, exclusivity, or service. Increasing the perception of value allows you to justify price increases without losing customers. 5. Diversification of revenue sources, increasing financial resilience. One of the most effective ways to ensure scalable and sustainable growth is to diversify revenue sources. This means that in addition to relying on sales of a single product or service, you can explore new business opportunities that add more value to your customer base. Diversification can involve launching new products or services, expanding into new geographic markets, or even offering different business models, such as subscriptions, direct sales, or strategic partnerships. The more revenue streams you have, the more resilient your business will be to market changes or seasonality. Practical tip: before diversifying, carefully analyze the market and consumer behavior. Diversification should be based on a deep understanding of what your customers want and the potential of new market niches. 6. Monitoring financial indicators. Constant performance monitoring. A successful financial strategy is not a one-time action, but an ongoing process of monitoring and adjustment. To ensure that growth is scalable and sustainable, it is essential to monitor key financial indicators, such as ROI, return on investment, profit margin, profitability, among others. Financial indicators help measure business performance, identify areas that need adjustments, and also predict potential problems before they become critical. Establishing a routine for reviewing and adjusting the financial plan based on these indicators is essential to ensure that the company is always on the right track. Practical tip: use financial management software that offers detailed reports on key performance indicators. This data can be analyzed monthly to adjust the strategy as necessary. 7. Investing in innovation and training, preparing the company for the future. The scalable growth of a business does not only happen through physical or financial expansion. It also involves innovation and constant training of the team. To ensure that growth is continuous and controlled, it is important to invest in technology, automation, and team training. Innovation can involve implementing new processes, using technologies that increase efficiency, and creating new products or services that better meet market needs. Investing in training employees and leaders is also essential to ensure that the team is prepared to face the challenges of growth and make strategic decisions. Practical tip: encourage a culture of innovation within your company and seek to invest in technological tools that increase productivity. Train your team so that they feel prepared to face changes and take advantage of growth opportunities. Creating a financial strategy for scalable growth requires planning, control, and a long-term vision. From controlling costs to diversifying revenue streams, every element of your financial plan should be focused on ensuring that growth occurs in a controlled manner without compromising the financial health of your company. By implementing these strategies and monitoring the results, you will be prepared to grow your business sustainably and achieve lasting success. No matter the size of your company, creating a solid financial strategy is key to the scalable growth you seek. My business is too small to worry about a scalable financial strategy. This objection is common to hear from early-stage entrepreneurs who think that expansion and scalable growth are concerns for larger companies. However, it is precisely in the early stages that a well-defined financial strategy can make all the difference. Dispelling the objection: no matter the size of your company, solid financial planning is essential from the beginning. Small adjustments in cost control and pricing, for example, can have a significant impact on your profit margin. In addition, planning for scalable expansion in advance will allow you to grow in a controlled manner, avoiding financial surprises and cash flow problems when growth accelerates. The sooner you understand and apply these concepts, the better prepared you will be for future challenges. Objection: I believe that growing quickly is the best way to ensure success. The idea of rapid growth may seem appealing, especially when you see the success of companies that have exploded in terms of revenue in a short period of time. However, this type of growth without proper planning can do more harm than good. Overcoming the objection: rapid growth without a solid financial foundation can lead to serious problems, such as uncontrolled cost increases, lack of liquidity, and even bankruptcy. A robust financial strategy, which includes cost control, cash flow management, and strategic reinvestment, will allow you to grow sustainably. Long-term success does not come with rapid growth, but rather with controlled and intelligent expansion, which maintains the financial health of the company while increasing its presence in the market. First objection: I don't know where to start. Financial management seems too complex. Financial management is an area that intimidates many entrepreneurs. When you don't have a background in finance, it can be difficult to know what steps to take to create an effective financial strategy. It's easy to feel like you can't handle all the financial variables involved. Overcoming the objection: start simple. The first step is to understand and control costs. Make a detailed map of your current expenses and revenues. Over time, you will gain more confidence and be able to implement more advanced strategies, such as projected cash flow and raising capital. There are numerous tools and resources available to help entrepreneurs manage their finances, from financial management software to specialized consultants. You don't need to know everything from the beginning, but making the decision to start is the first step to overcoming this difficulty. For objection: investing in a detailed financial structure can be expensive and time-consuming. Another point that generates resistance is the perceived cost of setting up a solid financial strategy. Many business owners think that hiring an accountant, investing in management software, or hiring financial consultants is an unnecessary expense, especially if they are trying to maintain financial control internally. Resolving the objection: although investing in a good financial structure requires initial resources, it can generate significant returns in the long term. Efficient financial management can identify areas of waste, optimize processes, and improve profitability. In addition, good planning can avoid major financial problems in the future, such as lack of liquidity or loss of investment opportunities. It is worth remembering that without a solid financial strategy, you may be losing more money than the cost of good planning. Objection: I prefer to reinvest all of the company's profits to grow. I don't want to seek external financing. Some entrepreneurs prefer to reinvest profits to finance the expansion of their business, believing that external financing, whether through loans or investors, represents an unnecessary risk. Overcoming the objection: while reinvesting profits is an excellent strategy, it may not be enough to sustain scalable growth, especially if demand increases rapidly or if there is a need to invest in new products, markets, or technologies. Seeking external financing can be a smart way to accelerate growth without compromising the company's cash flow. The key is to ensure that the money raised is used strategically, and with a well-defined plan, the risk of external financing can be mitigated with careful analysis and a good financial management structure. 6. Objection. My market is too volatile. I can't plan for the long term. Market instability is a legitimate concern, especially in times of economic uncertainty or in industries that face high levels of volatility. This leads some entrepreneurs to focus only on the short term, avoiding more robust financial planning for the future. Breaking the objection. Even in unstable markets, it is possible to develop a flexible financial plan that allows you to adjust strategies as needed. Financial planning does not mean that you need to accurately predict every scenario, but rather that you have a solid foundation to deal with unforeseen events. Diversifying sources of revenue, strictly controlling costs, and constantly monitoring financial indicators are ways to minimize risks, making your company more resilient. Financial planning provides security, even when the future is uncertain, allowing your company to be better prepared to face unexpected challenges. 7. Objection. My business doesn't need a financial plan. We're doing fine as is. When business is running smoothly, many business owners believe that there is no need to change or adjust their financial plan. They may feel that what is working does not need to be adjusted, dispelling the objection. Even if a business is doing well, a robust financial strategy is essential to ensure that current success is not fleeting. Ongoing financial planning and performance analysis help identify new growth opportunities and keep costs in check, preventing the business from losing its way if circumstances change. Without planning, growth can become uncontrolled, and the business can lose focus on key aspects such as profitability and long-term sustainability. Overcoming objections to financial planning for scalable growth requires a change in mindset. Long-term success depends on effective financial control, detailed planning, and ongoing management. When you invest time and resources into building a solid financial strategy, you are laying the foundation for controlled, sustainable, and above all, safe growth. The biggest mistake is not planning or expecting growth to happen without rigorous financial monitoring. By following these steps, you will be better prepared to scale your business successfully without compromising the company's financial health. Now that you've seen how financial management, strategic planning, and the idea of scalable growth can transform your business, don't stop here. If you want to continue learning and applying strategies that will boost your success, be sure to check out our other exclusive content. Here you'll find more practical tips on management, finances, and how to achieve the financial health necessary for sustainable growth. Subscribe to the channel, turn on notifications, and always be the first to receive new videos full of valuable insights. Let's work together to make your business grow in a solid and efficient way. See you in the next video. See you then.